Today's rise in yields follows DoubleLine Capital CEO Jeff Gundlach saying, quote, "The last man standing was the 30-year, and it has definitely broken above a multi-year base. That should, over time, carry us to significantly higher yields." Joining in on the discussion to see whether bond markets are headed into bear territory is John Bellows from Western Asset Management. John, thanks for joining us this afternoon. What's your take in terms of whether this is just the start of something much more meaningful in terms of bonds selling off, yields rising?
Well, look, it's been a volatile week, but I think when you're in volatile periods, you have to return to the fundamentals. I think this talk about trend lines or what's holding and what's not really isn't very useful. We're not aware of a long-term track record based on technicals and charting. You really have to focus on the fundamentals. Now, when you get into the fundamentals, the reality is growth has been okay in the United States, okay to good. And that was obviously true this week. We had a very positive jobs report today coming after some surveys that were pretty good this week. However, we resist the idea that we're seeing an acceleration in growth. You know, take today's jobs report. The 3-month average of non-farm payrolls is 200,000. That's unchanged for the year. That's unchanged since last year. It's unchanged since the year before that. And it's actually slightly lower than it was in 2015. So we're not seeing an acceleration in growth. Yes, it's good. Yes, that's enduring, but it's not accelerating from here. I think the bigger message is that we're having continued growth without running into supply constraints. We're not seeing inflation. We're not seeing any acceleration in inflation. And in fact, you had a number of speeches from the Federal Reserve this week where they reiterated their view that the low inflation environment is likely to continue. They're not worried about high inflation. They're not worried about higher wages. And as a consequence, you know, we don't think that the Fed is going to do much different here. You know, and I think that's the thing to focus on. So yes, growth's been good, but it's not accelerating. Inflation is certainly not accelerating. And the Federal Reserve is kind of unchanged as they look at the landscape with unaccelerating inflation.
John, is there a rate at which you would be concerned? For a long time, we were watching the 3 handle on the 10-year. We've passed that. We're getting much closer to 3.25. Is it 3.5? Is it 4% where you start to get a little concerned?
Well, again, I'd point to the fundamentals. I would agree with the characterization that better growth this year has corresponded with higher yields. You know, if the previous person said that was for the right reasons, I think that's largely right. However, as we look forward, you know, if growth moderates from here, which I think is likely, and inflation doesn't accelerate, I wouldn't expect yields to keep going up. I think we're at the top of the range, and over the longer term, some moderation in growth and a lack of acceleration in inflation are going to keep yields relatively low. Now, from an economics perspective, what you worry about is you worry about a tightening in monetary policy or a much higher yield structure in the absence of growth or inflation. I want to say emphatically that's not what's happening. We're not seeing a tightening from the Federal Reserve. We're not seeing a hawkish shift. Again, they gave speeches this week about low inflation. They gave speeches this week about letting the economy continue to recover. That's not what hawks say. Those are the speeches of dovish Fed officials. And therefore, I think you don't need to be too worried at current levels.